Good morning, ladies and gentlemen, and thank you for once again having the patience to listen to Tom and me talk about markets. It's a real pleasure to have you here on what is, at least in London, absolutely glorious summer's day, and we're looking forward to a scorching weekend. Of course, last time we had a market update webinar was in early April, and it was the pit of the Trump tariff turmoil. And markets were in a very jittery mood, having fallen in equity market terms quite aggressively. And indeed, the bond market had also had a considerable wobble. What a change. What we'll like to do is discuss what has driven that change, where we see things going from now, and some general comments on the world and markets overall. As always, our format will be about 25 minutes of Tom and me talking about the world. We'll be asking each other questions to draw out some of those insights, we hope. And then we'll take some questions, or we'll answer some questions we've had posted. Thank you for those. And so overall, we hope to complete by about 20 to 11. So without further ado, great to have Tom Becket with us again. I'm going to kick off. Tom, our thesis for some time has been that after the easy 10s, the easy 2010s, when interest rates were very low, this decade was going to be the turbulent 20s. And so as we go through this year, this particular year, coming up to halfway through, is this so far the most classic of the turbulent 20 years we've seen so far?
Well, thank you, Richard, and thank you all for joining us. Delighted to be here, and conversations and predictions perhaps a bit easier than they were back in the pit of despair, as Richard referred to it as, back in April of this year. The year so far has been extraordinary, and in direct answer to your question, yes, this has been the most classic example yet of a year of the turbulent 20s. 2020 itself was obviously extraordinary from the perspective of the pandemic, the economic volatility, and once in a century type conditions that we saw with regards to what was happening through society. 2022 was another extraordinary year for financial markets, where we saw extraordinary volatility and perhaps the breaking down of the perceived and understood relationship between equities and bonds offsetting each other and both falling together in tandem. But this year, we've seen pretty much everything which has encapsulated the turbulent 20s so far. I'm not trying to put anyone off the rest of this webinar, but let's just sum it up very quickly. Geopolitical tensions, politics being chaotic. Now, of course, they're supposed to be chaotic, but particularly chaotic this year. Societal divides, economic uncertainty, persistent concerns over inflation, and question marks over what might happen with interest rates next. However, and this has been the tale of the turbulent 20s so far, has been you've had all of that, but at the same time, private client portfolios making progress and a positive return. So those things put together, the positive returns alongside a lot of stuff going on, means this is the most classic turbulent 20 year yet.
Yeah, thanks for that. As you say, very turbulent. And at the beginning of the year, we kicked off our sort of look forward for 2025 by saying we thought we'd see a decent outcome for private clients, both from equities and from bonds. Clearly, that was feeling a little bit challenged back in April, but we held our ground. Right now, then, after a big recovery and strong progress in private client portfolios, has our view changed? Do we think that from here it's going to be as benign an environment?
No, not massively, but before we get on to that, let's just tackle that last point that you made there just quickly, because obviously when we were doing the last webinar back in April of this year, it's obviously very easy for us to sit here and say to people, don't panic, don't capitulate like lots of people were in financial markets, stay the course, embrace the volatility and try and turn it into an opportunity. But that was absolutely the right thing to do. And I think the key point to take forward is we're going to see lots more examples through the turbulent 20s when it feels very uncomfortable to be an investor. But that's often the worst point to jettison your portfolio and move into cash. And that proved to be the case from April through to where we are now. And we'll see further examples of that in the future. But interestingly, despite the introductory question, all those things that are going on around the world, actually our views haven't really changed a lot since the start of the year. If you think about things from an economic perspective, certainly risks around a global recession have risen, But our view remains that global recessions are really quite rare. There's only been two in the 20 plus years that I've been investing, one in the great financial crisis and one that short period at the start of the COVID crisis of 2020. But that aside, we haven't seen global recessions. They are quite rare. And you'd have to see a really miserable performance from the US economy alongside weakness in China to achieve that global recession. Now, clearly risks of that have risen, but we're still very much of the view that the global economy will be slow and low in terms of economic productivity and growth. But ultimately, that's not a disaster and pretty consistent with what we said towards the end of last year. At the same time, and I'm not in the room with lots of people here, so no one can throw anything at me if you think about your own inflationary experience. But whilst we are seeing a bit of pain on the inflationary front at the moment, more on that probably in a minute, actually, we expect to see a resumption of the disinflationary trends once again by the end of this year. So again, our views haven't changed, even if we are going for a painful summer hump of inflation in the UK at the moment. So putting together those two big components, the decisions around interest rates, economic activity and inflation, assuming we're not far wrong, and we do see positive economic momentum, albeit at a slower rate of growth, and we also see disinflationary trends resume by the end of the year, that will mean there's another couple of interest rate cuts in the UK this year, and probably a couple in the US later on this year as well, which will mean that our view of lower interest rates for 2025 is upheld. And putting all those things together, and much easier to talk about this now, Richard, than it was 3 months ago. Well, actually, from a fixed interest perspective, fixed interest markets have consistently churned out positive returns through this year so far. But equity markets were, really negative and really weak in the middle of April. So to say that we expected to make positive returns from equities this year, and both bonds and equities to drive private client portfolios upwards, was quite a controversial thing to say there. Much less controversial today, and our view still remains that we will see positive returns from portfolios in 2025, and that's despite everything that's going on.
Yes, and of course, one of the key factors behind that turmoil earlier in the year was the Trump approach to tariffs. Trump, of course, Marmite president. Some people love him, some people hate him. What score do you give his first 5 and a bit months in terms of this presidency?
Well, here we've got the opportunity to be really, really disliked by lots of the audience. But we'll leave that to one side for a second. And I just want to make a point on this at the very outset, because I would believe, and I believe strongly, as do you, that clients entrust us with their assets to manage on the best way that we can do to achieve attractive risk-adjusted returns. And to be able to do that, particularly in the political climate we're now operating in, we are paid to be apolitical. To take a view on what's happening in the US with the Trump administration, or in the case of the UK with the Labour administration, and to make investment decisions based upon political biases would be a surefire way, we believe, to underperform. So we leave our political views at the door, and then we think about asset markets. And I think if one takes a balanced view on what the Trump administration has done so far, I think you have to come up with the answer that they are achieving most of their aims. Before Trump took power in January of this year, towards the end of last year, he and his Treasury Secretary, Scott Bessent, made clear that they were pursuing certain aims. Ultimately, they wanted to see lower inflation. One of the reasons Trump was elected was because of the inflationary experience under Joe Biden. They have achieved that. They wanted to see lower bond yields or borrowing costs for the US government. They have achieved that. They're yet to see the interest rate cuts, which is why there's such a battle between the Eccles building, the Federal Reserve, and the White House itself. But they have achieved lower borrowing costs. They've looked to try and achieve economic growth, and the US economy is still growing. They wanted to achieve higher equity prices. We are seeing that. So I think as we sort of sit back and put aside the sort of toxic political nature of the world we live in now to one side, we would have to argue that actually the Trump administration has been able to achieve most of its aims. We also made the case back in April of this year that we were likely to see, without wanting to echo President Trump himself, some pain before we saw gain. If we all think about what the Trump administration's pursued so far, government efficiency, pursuing immigration, and to try and reverse the flow of migrants into the US, and also focusing on trade and tariffs, which were very low down the list of priorities of voters, All of those things were likely to provide some pain to the US economy, which, when combined with one of the weakest economic winters because of the cold weather, that put together meant there was pain for the US economy in the first few months of the Trump administration. But ultimately, with the passing of the One Big Beautiful Bill Act, it is actually called that. We're not making it up. And the reconciliation of the US budget, that will see a second half where there is some gain after that pain. And there should be, with the extension of the tax cuts and the various new ways of approaching spending, and of course, the signing off of research and development to be booked against your profits, against your taxes to improve your profitability at companies, those should provide some economic tailwinds after a first quarter of this year where there were more headwinds. So I think on balance, and again, being apolitical and putting all the political nonsense to one side, as hard as it is, we have to sit there and say that all of the worst fears of the Trump administration from an economic perspective have not been realized, and the US economy continues to be solid, even if unspectacular.
Yeah, thanks for that. You did allude briefly in your answer to inflation. And obviously in the UK, we've seen some worrying signs that inflation here is popping up a little bit. There you are. This is the white line of UK CPI, slightly diverging from our major trading partners in the US and the Eurozone. Is this a concern to us? And should we be worried about perhaps the Trump tariffs, which are in place and are generating revenues for the US government as we speak? Do we think that Trump tariffs might push up inflation in other areas as well, and perhaps in the second half of the year?
I mean, should we be worried? Absolutely. And I go beyond that and say that we should be obsessive about this, because ultimately, you and I believe that the real guide to future investment success on behalf of our clients is achieving a rate of return over inflation so clients can spend in the future like they are today with hopefully a bit more. That's the investment process and philosophy that you and I have stood by for greater than 20 years, and that very much holds to today. And the clear difference between the easy 10s and the turbulent 20s is that step higher in inflation. So in very simple parlance, if the ceiling on inflation for consumers in the last decade was 2%, you and I are now very much the view that 2% will be the floor. So achieving that inflation plus return on behalf of clients is going to be more of a challenge through the rest of the turbulent 20s. But ultimately, portfolios have made positive progress this decade, despite the increase in inflation and despite everything that's been going on in the world. But we're particularly right to be obsessive about this now, because as you rightly point out, the white line has started to tick up. And previous viewers of these webinars will remember that I said the greatest risk to financial markets was from an inflation perspective. And if inflation went up, that would prevent interest rate cuts, which would mean the economy would remain in the doldrums, which could lead to a marked revision down in asset prices, particularly in equities. Now, I don't think that's what we're seeing here. I think there's two things to pick out, one UK and parochial and one US and more generally for the world that we should focus on. With regards to the UK, the white line is going up because of awful April and the ratcheting up of all the services and utility bills that we have in the UK. So from a Beckett's household perspective, and I don't think we're necessarily atypical in this situation, my water bill went up 40%, despite the fact my children destroyed my house in the last year. The house insurance bills got up by 32%. We are trying to renegotiate with Nationwide on that one. And my Vodafone bill also went up by some 8%. That's what's happening with the white line here. Now, ultimately, that summer painful hump, painful as it is, should actually start to roll over, and we would expect, in line with the Bank of England's own projections, to see disinflationary trends by the end of the year. But if we don't, that is a really difficult place to find ourselves, and that would make us more worried about the outlook for financial markets and make us more defensive in our client portfolios. The interesting observation you made there, Richard, was also about the red line, which is the US inflation rate. Now, if you think back to mid-April, and this was viewed in consumer surveys and expectations around future prices and inflation, there was a real view that the tariffs were going to be super inflationary, and that was going to contribute towards a much more difficult economic patch through the summer. As yet, and I say yet, that has not been realized. We have not seen the impulse or impact on inflation from tariffs. Now, that might still be yet to come, but ultimately, we are not yet forecasting that dreaded second wave of inflation, which, as we move on to the right-hand side of this chart, this shows how many interest rate cuts are expected in the US. Actually, we're very close to what the market's expecting here, Richard, with something like 2 interest rate cuts in the US between now and the end of the year. I think the pressure on Jay Powell, the Federal Reserve, is rising rapidly because President Trump wants interest rate cuts and he wants them now. his wishes are likely to be fulfilled by the end of the year. If we start to see a rise, an uncomfortable rise in inflation in the US, that would really mean we need to seek to change our asset allocation and investment selections on behalf of our clients. But that is not our base case at the moment.
Yes, very much so. And going to fixed interest, your specialist subject, if I may, we started the year predicting with confidence that the headwinds to fixed interest, which had been things like high interest rates and high inflation, were going to turn into tailwinds. Are we correct? Has that come to pass? And how's our outlook now?
Yeah, well, let's deal with the headwinds first of all. Then we'll talk about the more sort of structurally positive views on fixed interest. I think that we would be naive and irresponsible not to make clear that there are certain parts of fixed interest markets around the world which are very dangerous. Now, ultimately, these very dangerous parts of the markets are actually compensating you for, at least partially and probably mostly for the risks you're taking. And I'm talking here about longer maturity government bonds. There is absolutely a case to be made that with yields having risen, for example, on the UK 30-year bond to close to 5.5%, you're now being compensated for the risks you're taking. These sorts of yields 3 or 4 years ago were substantially lower, somewhere close to 2%. There's been a marked change in the yields and so therefore the compensation. But as you can see here, we're seeing something truly extraordinary in the US, where there's now been a total breakdown between the normally observed relationship between unemployment rates falling and the budget deficit narrowing. The unemployment rate has remained very low for the last 8 years or so, even with the COVID spike, because that was only really very cyclical. But the budget deficit has continued to widen. This is not a political view. It was under President Trump, accelerated under Biden, and now maintained again under Trump 2.0. This is a risk because on the right-hand side, you can see the US's current situation with regards to debt to GDP outstanding and the overall amount of debt there is. We are in a new world, a new paradigm, and a long way away from Kansas here. We've got big problems at the long end of government bond markets. Now, we can mitigate against that and we can try and embrace specific opportunities, but that is the headwind. But that aside, Richard, we remain positive on fixed interest. I said that aside because it's quite a big thing, but ultimately we can mitigate against those risks. In a world of positive but low economic momentum, positive but lower inflation, and lower interest rates, but still higher than we observed in the 2010s, that is a supportive backdrop for fixed interest. If you combine that with the fact that yields are now higher, which is good, and also the very simple fact that companies are in decent shape and consumers are in decent shape, very different to the governments. That's where the problem is. That's why government bond yields are higher. We think that mates for an attractive backdrop for risk-adjusted returns in fixed interest. And assuming we don't see a material rise in the corporate default rate, which we're not expecting because companies are in decent shape, we think the outlook is set fair to continue to clip decent returns in fixed interest markets as we go forwards. So we're now going to change tack. And I'm going to ask you the questions, which I think is only fair at this point. Lots of people will know on today's call that you are a big fan of classical music. And whilst you pretend to like Wagner, actually, the real truth is that you're actually secretly a massive Oasis fan. Given that with all the news going on around the world, that the big news obviously is the reunion of the band Oasis. And you'll know, Richard, that they once sang that some might say that sunshine follows thunder. And to take those words onwards and think about what we've seen in equity markets this year, the thunder of April has very much given way to the sunshine of the last few months. It's been extraordinary, but what are your views on why that's been driven?
Yeah, it has been extraordinary. And look, it's one of the strongest recoveries ever in the US market over a 3-month period. Over 3 months in local currency terms, the US market has recovered by 25%. It's very comparable to the big bounces we saw in early 2009. And indeed from late March 2020. So what's driven that? Well, first off, there is the obvious factor. Trump in early April was brandishing his scorecard in the Rose Garden of the White House, telling countries how much he was going to levy against them, and indeed telling them not to retaliate, which China abruptly did. So Trump upped the ante very significantly to the point where I think we at one point were he was proposing 155% tariffs on Chinese exports into the US, a tariff level which would effectively have cut off the entirety of that trade flow, make the whole thing impossible to do. And of course, China had retaliated. He then pulled back. Now, this was unfairly, I think, called the taco trade, the Trump always chickens out. Unfairly because this kind of apparently chaotic approach to negotiating with the world is indeed Trump's tariff. He applies what's known as the madman principle to his negotiating tactics because he wants to keep his negotiating counterparties off balance. The last president in the US to apply that was probably Richard Nixon back in the late 60s, early 70s. So it's a bit unfair to say he always chickens out. He was almost certainly never intending to impose the level of tariffs which he initially provided. So that provided some relief to the fears about growth and corporate profits that went on. So that's the first thing. Even though every now and again, we have seen it most recently, you get little flurries. He's having a go at Brazil at the moment, for example. The next thing, and you've mentioned it, Tom, is that actually economic growth has continued on. We haven't seen some great dislocation. Trade has continued. We've managed to find ways to adapt to those tariffs, the 10% baseline tariffs we see. And inflation, as we said, has, outside of the UK at least, been pretty benign, which has helped overall market sentiment considerably. And the final factor, and it's an important factor, is that we are in the midst of a secular mega trend, which is towards artificial intelligence. And that has continued unabated. We saw roughly at the same time as we were presenting in April, the host of US companies reporting their first quarter earnings, which were very strong. At that time, earnings expectations were being downgraded because markets got very bearish about the outlook for economic growth. But since then, we've seen a big bounce in earnings growth expectations, especially in the United States, but also to a slightly lesser extent in Europe and the UK. And that sustained markets as well. So the combination of all those factors has provided a solid underpinning for equities in the second quarter of the year, I'm glad to say.
So has it been a case of a rising tide floats all boats? And I suppose the chart in front of our viewers today sums up quite neatly. Or have there been really quite stark divergences this year between the winners and the losers? And amongst those, there's been some significant changes to last year, hasn't there?
Well, yes. I mean, last year would have been talking about US exceptionalism in market terms and in company terms. But this year, so far, we have seen a complete trend reversal. So right at the top of the charts, you can see you've got Europe, that light blue line, and the slightly darker blue, slightly darker light blue line is the UK, leading the way. And there are a couple of factors behind that. First off, I think we pointed out and have consistently pointed out that valuations in areas outside of the US look much more reasonable. So valuations have been pretty good. Economic growth has sputtered on, I think we would say, in Europe and the UK. And in the Europeans' case, we do have a monster spending program from the Germans, both in terms of infrastructure and, importantly, in terms of defense, which goes towards another of Trump's key points. So yes, you can see right at the end, leadership now in white, that is Europe, rather than blue, which is the US. Not necessarily going to go on forever, but certainly there has been a change. We've got to bear in mind the effect of the dollar as well. The dollar has weakened, which means that against the euro and sterling, and that has helped sterling and euro returns relative to US dollar returns. So that's also been a factor. The other thing to bear in mind is that after all this, the valuations are very much back to sort of where we were in early February to mid-February, with the US looking a little bit pricey. The rest of the world, which had certainly in mid-April become decent value rather than just moderate value, has returned to maybe moderate to fair value. So nothing to get excited about, but still not overextended. But the US has now reverted to being really quite expensive, particularly as we know in the core Magnificent Seven names, which have all recovered what had been very big losses.
So as we think about markets as we go forward, and perhaps we'll come back to talk about sectors in a second. I just want to talk about whether or not this recovery can continue. In fact, let's go back to the sector chart, and we'll come back to talk about this in a second. But before we get there, I mean, can this recovery continue? You talk about equity valuations at an index level being back to where we were in February this year, which I think you and I back then were believing there was an element of complacency that was creeping into markets. And we talk about valuations which are probably at levels that we would consider to be fair to slightly expensive in the equity space. So presumably, in order to see the recovery continue, if it can, and you can answer that, we would also need to see earnings growth take place. So a couple of questions. Is there sufficient economic growth to drive corporate earnings positively? And secondly, if there's not, is this all about profit margins again? I mean, profit margins which are already extremely wide levels.
Yes, let me start off with disaggregating that question. In the US, there is enough background economic growth to drive widespread corporate earnings growth on top of the super normal earnings growth we're getting from those AI names. So I do think that's the case. And I think the fact that the US economy kept going in the second quarter is one of the key drivers for those that recovery in earnings estimates I mentioned earlier. The position in Europe and the UK is obviously less good from an economic point of view, but bear in mind that both in the UK and in Europe, a lot of companies have very large earnings and revenue exposures outside of their domestic markets, which means they're also exposed to that growing US economy. And so they too can benefit from it. But the story really relies a little bit more on cost cutting in those companies as well. So it's a slightly different story between the two. And we got to bear in mind that what I have described as a mega secular cycle in AI with spending, which is likely to continue to go on for quite some time. I don't think we're through all of that yet. So I think that can also help. And the rebounds and the rebound, in earnings expectations that we've seen in the last quarter, I think is rational and can help sustain equities from here. Whether that means we get a continuation of the incredibly rapid recovery we've seen since April, I think is a bit moot. The tech names have recovered very strongly, as I've said. And Europe and the UK and other areas never really seen such a big fall anyway in that period, as you can see in the chart. So I think we've got to be a bit more tempered in our outlook going forward.
Yeah, I think about things from a simplistic perspective, you being much more knowledgeable about equity markets, for me, much more knowledge about fixed interest markets. If you think about things from a sort of very balanced perspective, assuming there is some economic growth, as we've said, that should lead, as you say, to corporate profits growth, even if it's not going to achieve some of the loftiest expectations out there. Assuming we see corporate profits growth, that shouldn't mean that slightly expensive equity valuations are a big problem. And therefore, you might want to be selective, but it is still possible to make money from equities going forwards.
I'd agree with that. I mean, look, let's be clear. I'm a quite simple person. And for those of you who don't know that, let me just illustrate it perfectly for you. When I look at equities, in general, I like companies which are on a fair margin below 10 times sales. 10 times sales means that they're priced effectively at 10 times the current year's revenues. I also like companies which produce what's called a free cash flow yield. That means the cash they generate over the share price is over 5%, which means that over 20 years, the company will return in cash terms to its management the overall value of the company. And finally, I like companies, and I don't particularly like PEs, but in terms of price earnings ratios, I like companies generally below about 20 times or 20 to 22 times, that kind of area. So if I look at the tech sector, and I updated these numbers this morning, Nvidia, which has just become a $4 trillion company, the first one ever, is on almost 16 times 12-month forward sales. Broadcom, not very well-known company, but almost as big as Meta Systems these days, is on 18 times forward sales. And even Microsoft, a more reasonably valued stock, is on 11 times sales. So they are in expensive territory. Let's just be quite clear. Free cash flow yields, I can get Apple to have a 4% free cash flow yield, but all the others between 0.9 and 2.9. So they're quite expensive on that measure. It's going to take between 50 and perhaps even 100 years for companies to return the amount of cash that they're generating to their shareholders. And finally, in PEs, you're looking at things which generally are well north of 25 times, and in some cases on 40 times earnings. So none of these are cheap, but they're really enjoying enormous growth, as we've talked about before, in terms of the investments they're all making in AI and the opportunity which they're all trying to grab desperately to get competitive advantage, which means I'm glad to say with all that tech spending, their margins are super high and sustaining those valuations. So I think it can go on. I just want us all to be aware that we're not starting from a position of cheapness with these things. So we've just got to bear that in mind in terms of not necessarily expecting the size of returns we've seen in those companies in the last 3 years.
Yeah, and notably, while the tech sector has recovered, it's continued to be a difficult year for some of the more naturally biased quality sectors that you might like to embrace as well. Things like consumer staples and healthcare. And I think one of the things which should give investors some comfort as they think about equity indices that are back up at new record highs is that beneath the bonnet of markets, there's lots of different companies and sectors which are not trading at the high valuation multiples that the tech sector is. And that gives you some confidence and informs your strategy, doesn't it?
Absolutely. And look, that bottom line you can see there in red is healthcare. Healthcare has been hit by concerns about cuts to Medicare and Medicaid, included in that one beautiful big budget act, which are there, but also by a general sense that Trump wants to address high pharmaceutical drug prices rather, in the US. So that has derated relative to many other sectors and is now standing on pretty good valuations. We're talking mid-teens for many of the good companies in that area. And look, I'm afraid our hips aren't getting any better as we get older. People still need new hips, new knees, new shoulders. We're all getting older and hopefully living a bit longer. We, in general, in the world, we still are. And we are gradually, I'm glad to say, particularly in developing markets, becoming wealthier, so you get better access to healthcare, all of which underpin that theme, and it's not badly valued. So I think that there's plenty of leeway in some areas of the market. You're quite right.
Well, I was a bit worried then, because I was casting doubt on your musical choices, that you were going to mention the fact that at 46 years old, I may have my first hip replacement in the next few months. But there we go. So you're too nice a person. You didn't dwell on that specific subject. Thank you very much indeed. Just to finish off just quickly before we start taking the questions that have been sent in, just a sort of summary of where we are structurally from a client portfolio's positioning perspective. And we remain very close to client strategic asset allocations. That's on purpose. We believe that the relationship between bonds and equities is attractive. They have offsetting characteristics and both producing attractive risk-adjusted returns. If that sounds a little bit boring, beneath the bonnet of our asset allocations, we have some very selective approaches to investments, both in equities, where we have a bias towards quality sectors, and in fixed interest, where we still have a bias towards corporate credit and are still avoiding the longest duration government bonds. In aggregate, there are some specific opportunities. So we are making some high conviction and concerted investment choices beneath the bonnet of client portfolios, but at the moment see the relationship between bonds and equities as healthy and a good one going forwards. So just to finish up very quickly before we take the questions, I'm fully expecting to get the hard ones and Richard to take the softball ones, but we'll wait and see how that plays out in a minute. But this year has been the most classic turbulent 20 year that we've seen so far. A lot of stuff going on, but at the same time, clients making money from private client portfolios. We expect that to continue. Clearly, the Trump administration is mercurial, it's sclerotic, It's hard to read. A lot of the decisions that the Trump administration makes will be key to the outlook for inflation, growth, and therefore interest rates. But we're taking an apolitical view and believe in a central case where everything will muddle through. That put together, we expect to make positive returns from both bonds and equities through 2025. And it's a lot easier to say that now than it was only 3 months ago. But we stood by our positions, stuck to our guns, and that has played out in the last few months. So finally, it's going to be uncertain. It's going to be difficult. There's going to be lots of volatility, but we believe the balance of risk and reward, of attack and defense in client portfolios is appropriate, and we're acting with confidence as opposed to complacency. Thank you. Let's take the questions.
Thanks, Tom. Straight up one for you, I'm afraid, and I'm going to test your apolitical.
Doing it. Don't worry. Everyone knew it was coming. But let's go.
I'm going to test your apolitical mantra. A great question came in. We are, of course, a UK-based company, and our clients tend to be resident in or either close to the UK or in the UK. And clearly here, there's a lot of talk about difficulties with the Labour government's budgetary position post their pullback on some of their benefit cut pledges. And so tax rises in the UK. Your thoughts, Tom?
They're coming, within my view, because ultimately the Labour government has no choice. Now, let's be apolitical and point out that a year ago we said that was very much an election to lose because of the miserable financial, fiscal and stagnant economic situation that we find in the UK. This isn't being disastrously negative on the UK. We're actually positive on UK assets. It's quite hard to be very positive on the UK government situation, our fiscal situation, or indeed the economic outlook for the UK. And that's got ever more challenging. And ultimately, we can be apolitical, but still say the Labour government has made a lot of this mess for itself. They inherited a very difficult situation, but Rachel Reeves has boxed herself into a corner. And with the ideological pursuits that the Labour Party has around not wanting to cut spending and around wanting to try and achieve, a harmonious economic growth society, they're in a difficult corner. I mean, I quoted Oasis earlier. Let's take it back one generation and quote Rainbow and Since You've Been Gone. Well, they say these four walls are closing in. Look at the fix that you put me in. And that's absolutely Rachel Reeves's anthem at the moment. A lot of this is their own making, but they've got big problems. To balance the books, they are going to have to raise taxes. The obvious choices would be an inheritance tax once again, elements of capital gains tax maybe. And certainly there's the prospect of doing further fiddling around the edges with things like national insurance contributions. It's a pernicious situation. I appreciate that Rachel Reeves was crying for personal reasons last week, as said at the Prime Minister's questions. But ultimately, unfortunately, the UK's fiscal and financial situation is something to raise tears about. But let's dwell on some of those points just for a second, because ultimately you do have to draw a line between views on the UK the government situation and around UK government debt, where actually we've become a bit more positive. Short to medium term UK government bonds, we believe, it offer attractive risk reward for our clients, and we've shifted more money into that asset class in the last few months. So quite contrary to our views on what might be happening from a political perspective, if the returns are right, then we should embrace them and be apolitical. But what does this mean for a UK equity situation? Because that's been a real boon so far this year, a recovery return in UK equities generally. And in the last quarter, in complete contradiction to those concerns over the UK economy, UK small and mid cap really firing.
Yes, I mean, look, you've mentioned a couple of the areas that Rachel Reeves might look at to boost tax receipts, IHT being one of them. Last time round, she raised the level of, or reduced the level of relief on business property assets, including AIM shares, or the relevant AIM shares. We may see something more in that direction, which was a big constraint on the AIM market at the end of last year and the beginning of this. The key point, and I always make this point, is that ultimately valuation will out, and a lot of the SMID area, the small and mid cap area of the UK, remains pretty cheap by historical standards. And that cheapness is being recognized by the companies themselves, which are buying back their own shares, at record levels, by private equity companies which are buying a lot of UK small and mid-cap companies at the moment, and by foreign predators. The other thing to bear in mind is that the larger companies have the freedom to go elsewhere if they want to. And just earlier this month, I think on the 1st of July, AstraZeneca in the Times was reported to be considering relisting in the US. Now, the AstraZeneca has operations in Europe, Sweden and Cambridge, in the US and places in Massachusetts, and in China. It's an international company. It could list wherever it felt was best for it. More of its revenues by far come from the US and come from the UK. But AstraZeneca in listing terms is about 8 and a bit % of the UK market, which has shrunk as a proportion of the world a lot already. So there are pernicious outcomes from being too harsh on the corporate sector, which any government that wants a thriving capital market in its economy, which is a really important thing for companies to raise finance, should be wary of. So we do have to watch that. But UK valuations at the larger end are reasonable, at the smaller end are attractive. We are positioned a bit towards being overweight the smaller end. We think there are good opportunities there. And for clients who have got a more UK focus to their portfolios, we definitely have an overweight to the UK. For clients with a more international bent, where perhaps the UK is less relevant, we do want to play that smaller and mid-cap area in those portfolios, because we think it's a global opportunity, not just a UK one. One back to you, Tom, I'm afraid, in our sort of tennis match, our Wimbledon tennis match. I'll knock the ball back over into your side of the court. One of the best asset classes this year has been gold. And one of the worst asset classes has been broad commodities. Where do we go from between these two right now? Why have commodities underperformed? And what do you think the outlook is for that broader area?
Yeah, I would argue I'd like both. And it's possible to like both at the same time. But at the moment, I would prefer commodities. And the reason is that the valuations of commodities, by comparison to gold, are pretty much the lowest levels that they've ever been, and at previous levels of despair in terms of pricing, from which we've seen strong recoveries. Now, typically, commodity gains are cyclical rather than structural, and they go down to imbalances in the commodity world. And ultimately, I think that could be something that we see go forwards. I think having some gold in portfolios remains sensible, but I think broadly diversifying it into other commodities would make sense. One of the reasons why gold has been particularly strong so far this year and over the last couple of years has been because of the US government's decision to freeze the Russian overnight assets just after the Russian tanks rolled over the Ukrainian border back in the early part of 2022. And that proved to be a penny-wise but pound-foolish decision, because ultimately it really made potential buyers of US treasuries think about how safe their investments were in US treasuries. And they've been diversifying their balance sheets. This is sort of global central banks and moving assets out of US dollars and US treasuries and moving them in to gold. And that's why you've seen the gold price perform particularly well. However, if I was in charge of the Chinese, in charge of China and in charge of the Chinese government, I would actually be diversifying my exposure to commodities and having, much more copper, which is at a new record high, and indeed oil, filling up massive holes in the ground with oil supply for the future, because this is what the Chinese economy is going to need to drive it going forwards. I think that's an understated view. I don't think people have recognized the potential for that. And I think that could drive a surprisingly positive performance from commodities as we move forward. And one final point on this, and we only had to go out to 2022 to see this as an example. Commodities do have diversifying characteristics within portfolios. And you and I are obsessed about downside protection and inflation protection. Commodities can help with that, Richard. And in 2022, when we saw the falls in equity markets and the similar falls in bond markets, commodities actually rose significantly in price. I think it's worth having some of that in portfolios. So absolutely a bit of gold, and certainly I would be thinking about commodities.
Thanks, Thomas, very much talking to our ethos of balanced, diversified, and flexible. Well, I said we'd be using up about 40 minutes of your time. We're slightly over. Thank you for your questions. Thank you for your patience and for listening to us. Hope you found it interesting. Do get in touch with us with any further questions, through your account executive, and we'd be delighted to hear from you. We will again be meeting up with you, we hope, no earlier than October, because we will only have one of these between times if there's some disjointment in the market, some disturbance in the market we need to talk to you about. But in the meantime, I wish you all a very, very warm and happy summer. Enjoy the sport, enjoy the weather, and have great holidays. Thank you all.
Thanks for your support. Bye-bye.